welcome to the webinar where we take a closer look at the tools behind my stock scanner and the 3-point playbook. Using those tools, which we teach you how to apply, and then we'll show you our portfolio that last year achieved an upside of 34.48%. In other words, we provide the tools, you make the money. And Liam Flavelle, the guy next to me, Liam, you're one of the two persons behind the mystockscanner.com. This I'm telling for new people who've joined us and never seen us before. Tell us a little bit about the idea for mystockscanner.com. How did you come up with the idea? Oh, I need your sound
Unmute
on.
myself. That's always a good
Start
start,
with
isn't
that.
it? Yeah, good evening, everyone. We started my stock scanner, Hans-Henrik and I think we're into our third year now. And we basically came up with the idea. We looked at 4 or 5 different platforms that we used all the time and just said to ourselves, why can't they all be in the same place at the same time? And that's when that sort of light bulb idea came up, saying, why don't we just write it? Since it's not out there at the moment. So that's what we've done. We've gone out and tried to bring in the best of all the other platforms and the ideas and the concepts and put it into one place that we invest from. So we do this as well as just write that and provide the platform.
And that is where the portfolio gets into the picture. And one of the things that we're going to look at tonight, because we have lots of questions, thanks for that. And if you have some for us, please write us at fomo@mystockscanner.com. I'm going to repeat that in a second. But one of the things is important. That is, one thing is to enter a stock, but also a lot of questions about the exit of a stock. And it can be tricky because you sometimes are riding a high, you're going up, and you almost want to take your money and run sometimes, don't you?
It can be tempting, yes, and it's a very popular question at the moment because some idiot buffoon has started a war in Iran and caused lots of sort of turmoil in stock prices. So it's something that we'll cover quite a lot today in a lot of detail, showing how we think about things and what we do. So yeah, we'll see that in pretty much every stock.
As said, you can send us questions at fomo@mystockscanner.com. As always, what we strive for in each and every stock that we take a look at is take a look at the quality of the stock, take a look at the possible upside, and then we discuss to length the timing, because that's super important. On tonight's show, among other things, we'll take a look at Microsoft. We'll get to Apple. We have questions in regards to gold mining stocks, a chain restaurant in the US of A. We'll be discussing investing overseas in Hong Kong and other places. We'll look at energy stocks like Cameco and Danish investors. And we'll also discuss, as just mentioned, the stop loss and even if it's possible to have a stop win. Our inbox is open for you all along in the show. We are trying to keep the running time within an hour. fomo@mystockscanner.com, so reach out to us. But Liam, we posed a question pre-webinar. Should you sell everything and walk away from the market in time of crisis? And we have one right now in the Middle East. Is it time to just abandon ship and just sell everything and leave the market?
It's one way of looking at it, and actually in this sort of thing, Warren Buffett always says something quite sort of sensible in these sort of things when you look back at some of his past comments, and actually it's the preservation of capital that's the important thing in a crisis. So making sure that your money is safe and it doesn't go down too much, and that too much is really down to you and your own risk tolerance as well. Are we selling everything? No, we've sold. We were probably, I think, about 70 or 80% invested. So at my stock scanner, the subscribers to my stock scanner actually get access to our model portfolio, which is where we educate people. And this is what Jesper was talking about earlier on, with almost 35% in profit last year. So we were about 80, 85, 90% invested in that 2 weeks, 2.5 weeks ago. And we're now down to somewhere around 48, 50%. We've bought 3 or 4 actually this week and sold quite a lot because they dropped down, and we'll go through a few of those this evening.
We will, and talking about that portfolio that we have let's just say we've been bragging a little bit because our year 2025 was really something special, 34.48%. But we are not shy and admitting, Liam, that of course our portfolio is also under pressure at the moment in that sense that we have a drawdown. And if people
Yeah.
are new in investment, please define drawdown. And we're looking at minus 0.4%, I think, today in the portfolio for the
Yeah,
for
it's
the year.
easier rather than just describing it. It's actually easier just to show what we mean by a drawdown, and we can see. I'm just going to share my screen here very quickly. We can see the performances of our portfolio last year going up. We can see this bit coming down here. The drawdown is this, so it's the peak that we were at, and the drop from there where we are at the moment. You can see we had a similar one last year in April when the same buffoon actually decided to slap tariffs on the whole world. That caused quite a short, sharp drop, and then came back up again quite quickly. And we rode the wave up there very, very nicely. We aim to do the same sort of thing here. A 7% drawdown, it's not a huge amount. We expect 10 to 15% at some stage in the next 5 years or so. But the thing is, if you have a plan, then you can actually sleep well at night because you know what you're doing. You know why you got into a stock, you know why you're still in it, and also you know when you're going to exit. And that's what we're going to show you tonight, mainly focusing on the exit side of things and how to get out of these things. But we'll also show you the first bits, how to know what that plan is, how to devise it, how to stick to it, and then how to use it to time your trades coming in.
And this is all tied into the 3 point playbook that we keep repeating over and over. And we better take it for a spin. And we're going to have an example for you. I'm going to bring up a stock right now, which is Microsoft, because it's one of those stocks that's been under heavy pressure because it seems that it seems to hit the software at the moment because of all the AI. And everybody thinks that we don't need software anymore. We have AI, it can do everything. So Microsoft is a good place to start, and this is a test spin. Please take us through the 3 point playbook and show how it works.
Okay, I'm just loading Microsoft up. So the first part about this is really having a plan, like we're talking about. So the only time that I would ever panic is if I didn't have a plan in place, because it effectively doesn't tell you why you're in, why you should still be in, and when you should get out. So those are the three key drivers you should know when you press the button to buy a stock. We have the 3 point playbook, and that is basically a plan, and it really isn't rocket science. We are saying to people, you want to buy a quality stock because quality stocks are the way you want to be, where you don't want to invest your money in complete rubbish. You don't want necessarily to invest your money in speculative deals, though a lot of people do because they're exciting. We tend to find the boring quality companies that sort of are still ripened to go up. Then the second question, once you've ascertained it's a quality company, is it undervalued? Because what we don't want to buy, if it's a quality company, most quality companies out there are expensive already because everyone knows their quality. Therefore, there's less upside to it. There's less chance you've missed that wave. So we work out whether something is undervalued or not. And then the third question is now a good time to buy? And that's when we look at the technicals. That's when we look at the charts and give you some simple sort of ways of doing these things. So, but as I say, this stuff is not rocket science. Buy quality companies, buy them cheap, and buy them when they're likely to go up. That's pretty much it. If we look at Microsoft, I don't actually think we've ever had it in our playbook portfolio. This is our dashboard, by the way. So every stock has this dashboard. It has a description of what the company does at the top of it. If you're not familiar, Microsoft is obviously something that pretty much everyone knows, unless you've been living under a rock for the last 40 years or so. But the dashboard is really there to focus on the three questions that we ask. And is it a quality company? So the first thing that a lot of people ask is, actually, how do I know what's a quality company? What do I look at? And this is where we look at the profit and loss statements from a company. This is where we look at various bits of data, and we draw that out and we put it into some nice pretty diagrams. Basically, all through the system, green is good and red is bad. That's pretty much as difficult as it gets. So you can see here that the top three indicators that we're looking at here are ones that I tend to look at first, and Hans-Henrik tends to look at first, Jesper tends to look at first, and most of our clients do, I think, where they come in and we look at a quality score. Now, that is one of our scores. We have it on the system. We actually have the backing of this, what's behind it, and I think it's on our Facebook group as well. But it's a mixture of somewhere around 12 to 16 different bits of the company profit and loss. So to say, okay, how variable is its earnings? Is it, always going up, or is it just really, really zigzaggy? That's bad if you can't sort of, theoretically map out where it's going to go if it's not consistently going up. So those sort of things. So it's a mixture of about 16 of those. 97 out of 100 in this case is pretty damn good, and that gets me interested immediately. From an earnings per share point of view, we want the history to be going up, and then we want these gold bars here, which are which are the estimates going forward, to be rising up even quicker as well. So you can see here there are sort of, the stock is going up, and the analyst estimates are going up as well. So the analysts who follow this company, there's about 60 or so analysts that follow them. They think the stock is going to go up over next year and the year after that as well. So we've got visibility of some sort out there. So that's important. Then you've got the PEG ratio. The PEG ratio basically tells me how much gas is in the tank, how overpriced is the stock already. You want a low number, as low a number as possible, so closer to zero. So that's why Microsoft is just in the green at the moment. Anything over 2.5, and we get less interested because there's less chance of making a profit, because a lot of it might have already been taken by other people. That's the first bit that I look at. I look at those three things, and that's why I say anyone who uses the playbook and the dashboard can actually tell within about 15-20 seconds whether you'd be interested in looking further at the stock. And I can see that actually a quality score of 97, the earnings per share going up, and the PEG ratio being quite low is great. Then we go down a bit further. The revenues are going up in a great way. All the analysts love them. They've upped their changed their EPS positively over the last 90 days or so. There's some red around the returns. So the returns actually tell you how profitable, how efficient a company turns $1 of income into profit. So they're pretty good, but they have been better in the past, is what this is saying. And then you've got the free cash flow, which is how much cash the company actually generates. That's pretty good and pretty much rising over the last few years. The price to free cash flow is another metric that we look at, that we want below 35. It's just on the other side of that. I'm going to forgive it for that. And then we've got debt metrics where the current ratio is fine. It's just on that borderline. It's okay. And interest coverage is fine as well. So that we've taken a good couple, 3 or 4 minutes probably talking about this, but this is what we look at to work out whether a company is strong or not. On the flip side, if we're looking at potential exits and we own Microsoft, we'd be looking at this saying, well, if earnings suddenly dip down, say we had a war in Iran and the Straits of Hormuz closed and Microsoft couldn't get their chips that they needed over the next few months, or even towards the end of the year, then the earnings will dip. And if they start coming out here, if these start dipping down, that will be a good indication that actually the original concept of actually it's a quality company and the earnings are growing strongly doesn't match anymore. Therefore, we would look at potentially coming out of the stock.
And
We
one of the things,
go on.
Liam, that's here is, of course, we're looking like we're going to enter the stock here. But
Yeah.
you got to remember, when you have the stock, you still have to go back and check once in a while how
Yes.
it's standing.
Yeah, the playbook stocks that we choose in our portfolio tend to last. The winners tend to last about 6 months, something like that, 5 to 6 months, and the losers tend to last about a month. We kick them out very, very quickly, so they don't often have time for the fundamentals to change, which is what we're looking at here. That much it tends to be. It's the chart and the pricing action actually takes us out, but it's something we keep an eye on quite closely, because analysts do change their minds on these stocks, and things do happen that actually impacts on the company. So that's question one in a nutshell. Is this a quality company or not? And we give about 16 different metrics that actually say yes or no, whether that is or not. And we'll see some much less obvious ones as we go through the webinar.
And I also got a promise that we're going to speed up the
We
process,
will.
because the
We will.
thing is that now we're giving a thorough explanation to it. And now we go to step number 2, and we are slowly raising the speed here.
Yeah. Step number 2, you get a pretty picture that says, okay, how much is the stock worth in a couple of years if the analyst estimates that we just looked at are correct. So if we just go down here, we can see that the analysts think that last year the company earned $13.6 per share. Next year, the analysts think is going to go up 26%, and it's going to be $17 per share. And the year after that is $19 a share. And they think it's going to end up at 594. That's their price. So you can see that in the yellow line here. And that gives us a total return of 48% over the next about 14 months, something like that, until that happens. So that's what the analysts think. What we do with our value chart is we set the upper and lower bands of this to say, okay, in the worst case scenario, you can see here where the stock has traded based on these earnings, what's called the price earnings ratio, which is the appetite for risk that investors have got at various different times. And you can see their risk has gone up to the top of this green level. So I've moved my green bull case around so it matched in the past. And also from a bear case, the worst case scenario, I've matched weeks where, back in 2023 and also March, those were the low points for Microsoft. And that's when investors said, okay, the stock has dropped enough and it's now, time to buy. And that's where to come back in. And we're pretty much down there now where the investors have come in and reversed their decision in the past. And then I've set my bull case. Generally, I try and set it in midway between the and the bear case. Sometimes there's a good trend going up, and we'll see that where I've set it. But here you can see, okay, in the worst case scenario, we think there's a 20% upside. In the best case scenario, we think there's an 86% upside. And actually, we think in a perfect world, well, not in a perfect world, but actually in the real world, we could see 44%. So Microsoft is definitely undervalued for what it is.
Yeah, I'm gonna
Based on the
say, we're
earnings.
looking at that. That would make everybody lick the sort of lick their lips right now because
Yeah.
this looks really fantastic. And then we miss one of the things. Is the timing right, Liam?
Well, it is with the timing right. I'll just show you one very quick thing. Let's just change this. And let's say earnings dropped next year because the bottom fell out of the market. You suddenly get this situation where this comes down, and say that actually affected the lower case that we're going to go, and say earnings went down there, and say investors weren't willing to pay such a premium for it. All of a sudden, you're looking at losses. That's what we watch as well here, because actually, if that happens and analysts start dropping their future assessments for the company, then we look to reassess it and say, well, there's a 25% drop here, and there's a 44% upside. Is that a risk we want to take? And generally, the answer in this sort of instance is no. So that's very quickly, but yeah, generally that doesn't change too quickly either. We're on to question 3, which, now that we've ascertained it's a quality company and that there is, that it's undervalued, we're looking at the technicals. And here we're looking at 4 different areas. The momentum trend indicator, and it's an easy traffic light symbol to say whether a stock is in good uptrend or not. And you can see that from the 28th of August last year, the system has said the stock's not in an uptrend anymore. It doesn't catch the tops, it doesn't catch the bottoms. That's virtually impossible to do on a consistent basis. But what it's saying is the trend was fine up until here. The daily, which is what the top bar is, it started to wobble in at the beginning of August, and the weekly, because it's slightly slower moving, started to wobble in about the 27th of August. Everything went red after that, and whatever happens, Microsoft hasn't really been able to regain its footing after once that happened. So that's one thing that we look at for an entry, is those two need to be in green, or at least the daily has been in green for a couple of weeks, and we know the weekly is going to follow it just because of trends. The other 2 areas we look at are these 2 lines. So we've got a black line here and the green line. That is, the black line is the 200-day moving average, and the green line is slightly quicker. It's a 50-day moving average. And they're literally just the averages of the last 50 and 200-day moving averages. We also have a 20 here, which is slightly quicker again. I just use that just to see where that is. But the 50 is really the key for us, because you can see when the stock is in a downtrend, it generally uses one of these as a ceiling. When the stock is in an uptrend, it tends to dip down, maybe just dip below, and then dip back up again. And then it turns into a downtrend again and tries to hammer up through that ceiling and can't do it. So it acts as resistance or support depending on which side of the price it is. So if we see like here, we would buy somewhere around here because the stock is way above its 50. It's in a solid uptrend. Everything's just gone green, and we would enter the stock. Similarly, we would sell. We wouldn't sell right at the top here. We would see that actually the trend has been broken. It tests here a couple of times. It might test there. We'd probably come out around here. So we might lose somewhere around even 11% from the tops, which we have done in some of our stocks in the last couple of weeks because of Iran. But we've actually captured the lion's share of the upside here, which would have been somewhere around 14, 15% or something like that. So that is as simple as it gets. That's our plan. We know why we entered the stock. We know what made us enter the stock and what particular facets of the stock actually made us enter. We also know when we're going to get out.
And that's one of the things that is the key to the 3-point playbook, is that we are not falling in love with any stocks. They have to keep the rules, and if they don't bounce where we want them to bounce, they simply leave our portfolio. That's how it is. Liam, we're going to take in some questions. FOMO at mystockscanner.com. The first one we have is in regards to another of the magnificent seven, the big stocks in the US. This is about Apple. Hey, Liam and Jesper, I'm fairly new to the whole investment side, but I'm eager to learn. I bought Apple stocks at the end of November last year as I saw the stock bounce on the 50-day moving average, and it looks like it was in an uptrend, but the stock had been sliding ever since. What didn't I see back then? Thanks in advance, there is for Danny. And I kind of know that now of course, we're looking in hindsight, so it gets easier for us. But was Danny wrong to go in November, Liam? If we look at Apple.
Um, Not necessarily. If he's still in it, then maybe that is part of the problem that we've got here, because we can see here from my description just now, we would have been in Apple a little bit earlier. I seem to remember we went in and took a loss ourselves on Apple because it didn't quite play ball. So
And you
we
need to
we
share your screen so
oh,
we can
that
see
is
what you're
a
looking at. Yeah,
good
it's very
point.
important.
Gosh, it's that professional aspect of things, isn't
Yeah,
it,
it
that,
is.
that we miss actually. So we can see here that actually the best time to come in would have been, we want to be above the 200 and above the 50. You often see a stock come up, test the 200 or the 50, and then bounce back up again, and that's what we like. That's where the magic really starts, because that means that this is now acting as a support level, and you can see it almost bouncing down here onto the 50 and then bouncing back up again. So if we're looking at coming in around the 5th or 6th of November, the stock was in a good uptrend. I completely agree. If we go back to the 5th or 6th November on the valuation chart back here, it probably won't have changed too much. The one thing that I would look at here, just from a pure 3-point playbook point of view, is it's in the expensive zone. So it's something that we wouldn't have touched. We would have waited for it to come down here, because effectively what you're saying is back here, there is very little upside for this year. There's a little bit more upside, but it's something that we would wait for it to come down and drop down a bit on the valuation. So you bought it at technically quite an expensive place, Danny. What we would do if we bought it, and we have bought things in this sort of state at the moment. I think we bought a stock today, a restaurant chain in the US that's actually had a good run recently, but it's much lower on the valuation chart. But what effectively, if we'd have come in here, ridden it up, and then seen it drop below the 50, we probably would have gone somewhere around here, maybe when it breaks this resistance point here. So you can see this particular, we've got some red and green areas, which the system automatic maps support and resistance points. So these are points, if you look at this green box here, the system stopped here, it's bounced here, it's bounced here, it's almost bouncing here. So this green area is turned into a support point where it generally bounces. This red area is a resistance point where the stock hits, doesn't get through it, and then comes back down again. So we can see these support and resistance points. So we'll often see a stock dropping through its 50-day. It sometimes bounces and come back up here, but if it breaks there, we'd probably sold about 263. So I think we'd have come out maybe break even, maybe with a small loss, something like that, just by exiting. And you can see that often when the stock does that, it often has a great deal of problems bouncing through that 50 again. So it really does work as a support and a resistance test for your trading when you're going in and out of stocks.
I hope this was as for Danny in regards to definitely keep an eye out for when it breaks those 50 days moving averages. Also, one thing is when it's going up, but definitely also when it's going down. We're gonna move on to the next one because we'll try to reach as many of your questions as we can in this show. This is for Tina, who seems to know our playbook pretty well because she writes, "Hey, my stock scanner, you recently sold AU, and that is short for this one,
Cool.
which is Anglo Gold Ashanti. And can you walk me through the process slowly and tell me exactly what are the things and thoughts that made you sell this stock? Cheers and happy St. Patrick's Day," Tina writes.
I forgot about that. I've got
Yeah,
Guinness
you told
downstairs.
me.
Right, that's it for tonight. I'm going. No, I'm not. Um, Anglo Gold.
Yeah.
Um, right, I'm going to do this really quickly now. I need a drink. There we go. Anglo Gold. So Anglo Gold Ashanti. I'll just do a playbook very, very quickly because Anglo Gold, we sold it not because it's a bad company, it's because it just dropped. And you'll see why in a sec. So we've got a quality score of 98, earnings per share going up, peg ratio really low. We're already interested. There's only one piece of red area on here. Everything else is absolutely fantastic. So that is great. From a is it expensive or is it undervalued point of view, we break even at the end of the year with we have an 18% return. Analysts think it's 31%. We could get 90. So fantastic, fantastic company. Why did we come out? Because this happened, and everyone can see this now after we've done a couple of these stocks. It's been in an uptrend. We bought it somewhere around here, didn't we? In the playbook, I think it dipped down, came back up again, and we thought, yeah, now is the time to buy. The stars are all aligned, and we had a double green on the MTI down here. So we rode it all the way up. It hit up here. Again, some idiot started a war in the Middle East, and it shot back down again. Um, it broke off 50 and didn't come up anymore, so we sold it. And that's really the process. That's as simple as that. That we looked at it and said it doesn't fit our rules anymore. It's a sell. If it comes back up again, then we will buy it.
That's another thing. We're not never afraid to rebuy a stock that we already been in and take it for another ride. Sometimes it works, sometimes it doesn't work, but it has to play by the rules.
Yes, and that's exactly it. So yeah, everyone can see now, just from this simplistic sort of setup that we've got. There's nothing complicated about this. It's not rocket science. It's just basically saying we will buy when this stuff is in a trend, and when it's not in a trend anymore, we sell. It's really, really simple, and we're trying to be as boring as possible because we like to sleep well at night. So that's the key thing here. What some people will look at in here is saying, but hold on a sec, surely gold is a store of value, and people run to it in times of trouble, like we've got now. Um, the issue is that with gold, Anglo Gold is they produce, they mine the stuff, so it's quite energy intensive. They generally mine it in areas that sort of could be quite well affected by the Middle Eastern conflict, and it's in place in Africa and places like that, which these things could spill out to very easily because of the geographic location. Also, the dollar is the store of the ultimate store of value in these sort of times of pressure. So everyone wants dollars, and they will be selling gold, they'll be selling commodities, they'll be selling stocks to actually just get into naked US dollars. So that's where that goes. That will probably last 4 to 5 weeks if you look at historic issues like this war and other sort of happenings over the last 20, 30 years or so, and then things start turning around to become what's a bit more logical for us maybe. So what we also say, an understanding of the macroeconomic events around here can be important as well. So you can understand why companies like Anglo Gold drop. That's one thing that we cover a lot for you guys. I know lots of people sort of your eyes start glazing over when I say the word macroeconomic. We had an email the other day from someone saying, "Thank you very much. I've sat through a macroeconomic talk and I've actually understood it, and actually I've enjoyed it as well." So we do turn some people into nerds in that way, but actually we write reports every day that actually covers this and tell you why things are dropping, why things are going up, and so that you don't actually have to understand the ins and outs or sit there and watch Jerome Powell go and speak at the Federal Reserve for 20
And
minutes or half an hour or whatever.
It is one of the things that we cover on our platform, and you can get it if you are a member, and you can even if you sign up for a test run where you can get it for free for a full month. Then you get to see the market scan that Hans-Henrik Nielsen puts out every morning before 9 o'clock on weekdays, and he does the macro thing. I'm going to jump here a little bit because we're going to bring up, we already talked about it, but I'm going to talk about it some more. The stop loss thing, because that's really something. And just Liam, walk me through this one in regards to why don't we have stop losses where we basically decide this is the price. If it goes lower than that, we're selling it automatic. We don't have that. We basically handheld everything.
We do, and there is a good reason for that. For this sort of investing, and certainly we Hans and I started our partnership on our algorithmic trading, which is where the system actually tells you what to buy and what to sell and at what times. And we still have an aspect of that within the platform as well, which is actually doing pretty well this year. Um, what you tend to find with these sort of hard and fast rules is that hard and fast stops and take profit levels, which is the other side of things, don't tend to work particularly well, because sometimes you have to have them so far away from where you entered the stock that actually you're taking a 40% loss on a stock anyway, and it only gives you that marginal protection. I can probably give you an example.
I'm going to hold on for that example
Okay.
because Matthias wrote us at fomo at mystockscanner.com. You're welcome to do the same here as the show spins along. And he is asking in regards to couldn't you take the stop loss and use it as a stop win,
Yeah.
uh, but just move it higher where you decide if I make 25%, I'll take my profit and run.
You can do that, and it depends on your strategy. Is the easiest way of actually giving the answer, and it's not a particularly good answer necessarily, but it really does depend. So our algorithmic strategies and the playbook strategies don't work particularly well with a fixed stop loss because and a fixed take profit, and they're called take profits rather than anything else a lot of the time. So it's just an example. We've got Zealand Pharma here, a stock that all of you Danes know quite well because maybe you like, I don't know, roller coaster rides or something like that, because it certainly looked like one over time. If you look at taking a take profit, for instance, let's start with the positive side of things. Say you got in here and you thought, okay, I'll take a 25% profit. That that brings you out somewhere around here. You've actually missed out on this whole area. Um, and if you did the same up here, you would potentially lose out on even that 1 day move would actually take you out completely, and you wouldn't get the benefit of it going forward. So what we tend to find is the adage in investing is you cut your profits, cut your losses early, and you let your winners run. And that is exactly what momentum trading, which is what we're doing here by following the trend, actually does. It allows you to let the winners run, and then when they don't become winners anymore, you don't get them at the top, but you actually cut them somewhere around here. So we'd have been in Zealand Pharma potentially, assuming it was a quality stock back here, potentially from, I don't know, this point, let's say, and we would have come out a bit there. So you'd have seen a 224% increase. We probably wouldn't have been in it back here. We wouldn't be in it up in this point. So, but the stop loss is important as well, because actually, if we'd have put a stop loss here and maybe sort of come out too early because it's dipped, it hadn't really dipped too far below its 50, and it seems to have support back here, then actually we would have missed this run up as well going in there. So that's another reason why we don't have this take profit. So you can see here that actually for the stop loss to protect us here, it would have to be 22-23% stop loss from the top to say, okay, from here, we need to swallow a 22% stop loss to actually get that rise coming in at the top there. So that's why stop losses in these sort of strategies often don't work. And we've done a huge amount of testing on these things, and the playbook, because it's you've still got decision making to do as an adult sort of investor. Is difficult to go and back test. But when we're looking at very similar strategies that we automate, then I've found that 40-45% stop losses are where you need to place your stops before they actually start hurting before they start protecting your positions over time. So, and I've gone back 20 years back test to check this stuff out, and that's the sort of level we often find. Anything less, and actually you get less performance coming out. This, I need to just say, that's not true of every single strategy. You need to look at it, you need to test it yourself if you can, but it certainly is true of the ones that we run in my stock scanner.
We're hoping to cover Vestas, Cameco, Alibaba, and Darden restaurants before the show is over here. We're going to broadcast for another 25 minutes. Right now, we're going to use basically the same thing that you just went through and take a look at Rheinmetall, because we had a question in regard to that. Isn't it time to get back into Rheinmetall? Is a question we had at fomo@mystockscanner.com. And admittedly, Liam, Rheinmetall was one of the favorite stocks of 2025 for sure.
I think it was the favorite one, wasn't it? I think we were up 170 something percent or something at one stage. So, which, I mean, we spotted. We just go through Rheinmetall. I won't go through the playbook again. Everyone now, just can see the top three, the top lines: 86 quality, earnings per share great, peg growth. Everything's great about Rheinmetall. It's a very strong company. There are a couple of reds down here that we'll go through maybe in the beginners. From a valuation perspective, so yes, it's a quality company, and that hasn't changed. We actually got into the stock in February, about mid to late February last year, because we saw that it was significantly undervalued for the bucket loads of money that the EU were putting into the defence industry in the European Union. So we saw a massive rise, and we rode it all the way up here. We came out somewhere around. So it's definitely our best performance in a single stock last year. Is it right to go in it? Is it undervalued at the moment? Well, everyone can see from the value chart, it looks like it's bouncing off of this red line. You could actually put the red line slightly lower. Everyone, when we were sort of starting to go off Rheinmetall a little bit over here, when we started lowering these aspects, everyone's saying, actually, it's not going to go down there. We're spending trillions of euros in the defense industry. Why would it go down again? Well, it has, and that's what you often see is a stock when it's gone up so much, it needs some time to digest that move. But we can see that actually there's a downside towards the end of the year of 12% in our worst case scenario, and an upside of 100. So absolutely, it could well be time to go in because it's a huge quality stock. We came out, I think it was probably around here. It might have even been around here, something like that. Because we broke the 50-day average, and that was it. It was out. We didn't fall in love with the stock, but we did look at it thinking, actually, it's a quality stock. We'd love to get back into it. But since then, it has come up a bit and then drop down again. We could have gone in. What we often try and do is get that quick bounce and then a retracement back up, and that's what we're looking for in this zigzag here at the moment. But the stock has had a real trouble keeping its head above water here, so we're actually looking potentially at the stock breaking this resistance level that it hasn't been able to get past for the last couple of months or 6 months or so, before we're fairly confident that it's going to carry on going up. And you can see here the 200-day has started turning over as well. So that just makes it more difficult for the stock to actually break through the 50. So at the moment, we wouldn't go into Rheinmetall right now simply because the third part of the playbook doesn't allow us to. That's the rules.
And again, we do the research, of course, as we do, but we also think in regards to a stock like that it's an industrial stock, which means that to get more production, they have to build big factories. They can't just turn a button and then just produce more.
Out comes a tank, yeah.
Exactly. So
Yeah,
in that sense, that takes a while for them to sort of pivot towards that.
it does, and that's the understanding of the macroeconomics that go behind it. But often we'll take that into account when we're buying, and we'll take it into account when we're selling. We don't normally take the macro into account when we're in a position, unless something really, really dire happens. But even with us coming out of 30% of our stocks over the last couple of weeks, they've been based on the 3-point playbook rules. They haven't been because we're going, the US is going to war with Iran, because who knows what's going to happen. It could be over tomorrow, in which case you're out of a stock that's really good, could bounce up. So that's why we watch the macro side of things, but we use it to guide us in our buys, before we go in there.
And talking about buys, we have a question from Kurt that's stateside, and he might watch it on a rerun because we record this and then we make it available for our members. He noted that we bought a restaurant thing. I'm not going to say which because you have to be a member to be privy to that information. But he said, I went back and looked at DRI, and that's Darden. That's can you say they own a lot of restaurant chains in the US. Olive Garden is one of them. And he says DRI was under the 50-day moving average. Why didn't we buy that instead of what we bought? I know that's a tricky question, Liam, because I don't know if we are buying stocks because we like the restaurants or we don't like the restaurants. That's not how we do it.
Not at all. And we've had that discussion internally a number of times with brewing shares and with alcohol shares, where we've had
Yeah.
a couple of alcohol shares recently, and there have been discussions saying, should we be in this or not? Because no one's drinking anymore. But we made money on them because it's not because we like them or not. Though we do quite like Carlsberg and Unibrew and Budweiser and things like that.
And it's not
But
because
yeah,
that Liam wants to buy Guinness. That's not it. He, on the other
no,
hand, you have really stayed away from Diageo. That is the
yeah,
company that owns Guinness. But
yeah,
let's
yeah.
look at Darden here.
Darden, okay, 30 seconds. 87 quality score, earnings going up, PEG ratio 1.14, so well under 2.5. The earnings are great. The analysts, no, actually, that's all right. They're down 0.2%. That's absolutely fine. The analysts do like them. The returns and the profitability is fine. It's making cash. So in, what was that, 25 seconds, yes, it's a fantastic company. So I totally agree, Kurt. Is one that we could go into. Um, I think, again, Kurt's view was, I saw the email he sent in, that he didn't eat in the one that we bought, but he does eat sometimes in these ones. So, he liked them. Are they undervalued? Actually, the answer is probably yes. So Kurt's got it spot on there. If we look at sort of the bottom lines here where it's bounced before, we're off the lows definitely, and you got the top here. So potentially 38%, 16% that we actually think's going to happen, and a seven. If we're wrong, we lose 7.5%, which is easily within our tolerance. And one thing we always like to see is that if we, if you just make this positive and double it, is it still less than our base case? So that's basically saying from a risk reward, we are going to get twice the reward compared to the risk we're taking. So that's how we think about these things. That's how we stack the odds in our favor. So I'd probably like to see this a little bit down. So I'd have preferred to see this go down a little bit more. One thing that is nice to see it bouncing on the analyst line. So it might mean that the analyst line is actually correct, in which case we go down here and just drag our case down a bit, in which case we're pretty much one-to-one risk reward. And that would be a good reason for us to wait until it drops down a bit more, if it drops down a bit more. If it doesn't, I've got 500 stocks on my watch list that I can go and buy if it doesn't drop down. So that's the important thing here. We're not pushing ourselves into a trade. And then from a technical point of view, um, I think Kurt came in yesterday with this, didn't he, or the day before? So it's actually just below the 50-day moving average. It's above the 200. It's bouncing off of this support level here. Yesterday, Kurt, when you sent the email in, we had a red MTI for the daily, but it has just turned green last night, and the weekly is green, is in an uptrend as well. So if that came back down again and bounced, then absolutely we'd be interested. But right now, we don't know whether the stock is still in an uptrend or this is just going to be a ceiling for it. So we would actually rather wait and see, and maybe lose 2 or 3% because of it. But that's the price of a bit more certainty compared to the risk.
If you just joined us or joined us later in the show, the thing is that you can rewind as we are talking here and go back and see what our opinions about Apple and Microsoft, amongst other things, earlier in the show. But right now, we're going to talk about stocks that you buy overseas. It could be a Chinese stock that's available on what's called ADR. That means that it's an associated stock it's equal to be the real stock, but it's just being sold on the American exchange. We're going to talk also about the possibilities of buying stocks from the Chinese mainland, but buying it in Hong Kong. But let's talk about Alibaba in that situation, because that's a huge stock, a huge Chinese company, and they're being traded on the US exchange. Take us through the various scenarios of buying these stocks. Hong Kong, US, because you can't buy them in China, of course.
You can't buy them. You can't buy them on the Chinese exchanges. So the Hong Kong one is generally linked. So when a stock lists on the Chinese exchange, they often find it easy to get access to Western capital by listing on the Hong Kong exchange, which people can go into. Important, just pick you up on one point that you made just now. You said that stocks were equal. They're not. So the ADR stands for something called American Depository Receipts. We also have GDRs over in Europe, which are German depository receipts. Basically, it's not your when you buy a stock in a company like Apple or Microsoft or any of the ones we talked about so far, you're buying a part of the profits of that company. You're actually a shareholder of that company, and you can have some say in how it's run. And the more shares you have, the more say you have. With an ADR, you're not actually buying shares of the company, the underlying company itself. You're buying shares in a third company or a second company that's generally in somewhere like the Cayman Isles or something like that for tax purposes, and you don't have the same voting rights. Or you don't have to have the same voting rights. Similarly, if the Chinese authorities decide they're just going to shut it down, then they just shut down that company in the Caymans. So you've got very much less protection on those sort of things. We've not seen it, but not in recent memory. But this can theoretically happen, and you're not as protected compared to buying the underlying share.
Let me ask you just a devil's advocate question, because you can buy Novo, of course, you can buy it in Denmark, but you can also buy it on the American exchange. Is that the same situation then?
No, it's not. So Novo in America have a secondary listing out in the US. So they're actually on that stock exchange as well. And when you buy a US version of their shares, they also have you also buy a part of the company.
So you have to look out for the ADR at
Yeah.
the end.
Yes.
Okay.
Yeah.
Well, the
Absolutely.
question is, you can buy, as mentioned, Carsten wrote us and said that, of course, you can buy Chinese stocks on the Hong Kong exchange. There's a small fee for it, but you could trade on the Hong Kong exchange.
You can do. It's difficult to get on there. There aren't many brokers that do it. So interactive brokers who I use do give me access to Hong Kong if I want to. I've not actually done it. I think they're opening out to Korea as well, which is quite useful. So we can buy some of the big memory chips and tech companies out there. But I think places like Saxo don't have it. I mean, they struggle with some US stocks we've seen today. But so you've got to choose your broker carefully, and if you want to go for these or what they call exotic exchanges. I mean, Hong Kong is one of the biggest exchanges in the world, so I don't see why it's too exotic, but that's how they view these things.
And in regards to Alibaba, as we just took a look at, can you bring it up in the 3-point playbook really quick? And just because now we mention it, and I want to see it on the American exchange, or not the American exchange, because they're listed on the American exchange.
Yeah,
That's what
they're
I'm
on. Yeah, so they're
Yeah.
listed. So the share prices will go, hand in hand with what's happening around the world generally. But so Alibaba, it's been so one of the services that our paying members get is they get what we call a stock of the day, and we choose a high quality stock that's undervalued. May not be a right time to buy a lot of the time, but we just bring it onto your radar so you can add it to a watch list and keep an eye on it. And we keep an eye on all these things ourselves. So our stock ideas that we actually put into our portfolio generally come from the stock of the day that we produced. And you can go onto the system and see the library of it in the forum. So you can get the older ones generally after about 15, 20 days or something like that. But to get it hot off the press, like our members did last year, then you can subscribe. Alibaba, in a nutshell, quality score of 85. Earnings per share is dipping and then going up next year, according to the estimates. We'll have a look at that in a sec, because people generally who've watched me talk about this before know that's something I don't particularly like and I don't particularly trust. Because the stock has dropped, we don't get a PEG ratio, because that's basically looking at the growth in earnings. But everything else looks okay. Yeah, we got some green here. We got some drops. So the analysts over the last 90 days have thought actually earnings per share is going to drop. From a tech point of view, I know that Alibaba is under a huge amount of pressure and competition within China, which is why the analysts are a little bit more lukewarm and also why their free cash flow and the returns are starting to drop, because they're just feeling the pressure of having to spend to stay in the market. If we look at the value chart, so yes, the stock is okay as a quality one. It wouldn't stop me buying it necessarily, but there are probably better ones out there. When we look at this, the value chart, when we looked at it last year, we were back here in August, and it was just before it shot up, and we missed it because again we were a little bit undecided on what the quality what really was, but it went up anyway. What everyone, all the analysts are saying, okay, the earnings per share are going to drop this year and then shoot up. When I'm back here looking at investment and the analysts are saying it's going to drop for this year, I don't really want it. I don't want anything to do with that. Again, I've got 500 other stocks in a watch list that I can go that are going to go up. Yeah, the analysts think they're going to go up for the next 2 years. So why would I buy one that's going down and I have to trust their execution that the stock is going to go back up again next year? So that's something that I don't particularly like and I don't particularly trust. In this case, the stock did go up, then come back down again. So we're at this point at the moment. Now we're here and earnings are just around the corner in a month or so, then there is some decent upside in the company. So you can see if the stock just hits its bear case that I put here, where it's dropped down to before, then we might see 2% loss if we go into the stock, and we might see a 17 or even a 70% upside. And the analysts think there's a really good upside as well. So it looks like a really good quality stock.
Um,
And
uh, Liam, I'm going to ask you one question because a lot of news in regards to Alibaba, in that sense that they're pivoting away from being sort of the Chinese version of Amazon and into all kinds of other businesses.
uh, pivoting, they'll still have a high degree of concentration. You know, like Amazon, you think of Amazon as a shopping site, but actually they're the largest data center company in the world, and that's the biggest part of their business. So you can pivot and you can start moving across, and that's probably one of the reasons for their drop in earnings per share, to be honest, as well as the competition, the amount of money they've got to invest in these things. But it's something that, you know, again, as an investor, I'm not sure I really want to buy into that unless I'm absolutely certain. I'd rather have a solid business, executes its plan and has done for years really well, and just carries on being really bloody good at what it does. That's the sort of boring company that I'm looking at, because I don't want this. Oh, it's gone up, you know, 80% in a few months, and now it's dropped 70% after that, because I get seasick. And this is a good example of it. You can see here just very quickly, you know, if we had a bought back here when I think Hans put the stock of the day up around here, we'd have seen a pretty good return coming up, and we'd have come out probably somewhere around here. Oh, mate, actually, no, we wouldn't have. Sorry, I'm using the wrong line. Come in here, and we'd have come out somewhere around here, something like that. So we'd have seen a 20% gain, but the stock has really struggled to make any headway above its 50-day. Yeah, this, we might have gone into it here, but then it cut back down again. But then the MTIs were red, so our rules sort of kept us from buying at any time after this drop back here.
So
Um,
we never get in at the bottom and we never get out at the top.
no,
We will get the good solid ones in between.
yeah,
One of the stocks that we have been in, and Pierre noted that, and he's asking in regards to energy stocks, he would love to get into something else than oil because he thinks it's too expensive right now. And then he asked, why did you guys sell Cameco? Shouldn't you have kept that and taken the ride right now?
it's an interesting one actually, because you and I both know that I was on holiday when the sell came through, and I actually kept it. So I think I ended up about the same level. Cameco is a uranium company, so you'd have thought, again, in this topsy-turvy world where oil is going out the window and we haven't got enough of it, that we'd automatically move to other energy sources. That hasn't really happened when we look at Cameco. So we owned it. We came out. I think we came out around here. That's because of the drop. I'll check for definite, but it was only, well, no, it was back, actually, I kind of, it might have been back here that we came out. I will have to check that one out actually very quickly, unless you can, yeah, Jesper, while we're talking. But effectively, we looked at this wild rise up here, jumped in somewhere around here, and then saw the energy market sort of fall out. And sometimes, when we get sort of a big drop down, like we saw, say, somewhere like here, the stock just drops out when there's no real reason to. That's sometimes when we take a call to say, actually, we're going to exit even though the stock hasn't dropped below our particular area. That is sometimes we have, yeah, every rule is there to be broken sometimes. And we looked at the macroeconomic times back there and actually said, is it the right time to come out of the stock? And actually, it's a big risk because the market's not going the direction we want it to. The other thing, just very quickly, and I saw it on Alibaba just now, when you have something called a gap, that tends to be bad. So you can see here, a gap is where a stock finishes one day and then has a massive gap where it opens the next day on the candle. So this shows the opening closing when it's red because it opened the stock up here and then dropped down here and finished here. The next day it opened here and pretty much stayed here. That's called a gap. In my testing of the 3-point playbook and what we were doing, a gap down tended to be a really, really bad thing. And it tended to mean that the stock stayed in the doldrums and didn't really break through anything for a while after that. So that's one of the reasons. Cameco has dropped below its 50. I think I sold yesterday here, or I might have sold here personally.
Yeah.
So I basically broke even, I think, on my trade, maybe a few percent up.
We came in the beginning of January. I think it was January
Yeah.
6th, and we went out beginning of February.
Okay.
That's the
So
ride we took it.
January the 6th, it came onto our radar. One of the things we're testing out at the moment is something called our stock map, which actually tells us of particular sectors that are going into, that are starting to go green effectively, and give us that green light to say this is something that's rising as a sector, so it acts as a tailwind. So we went in around January the 6th, and what day did we come out?
I think it was the 4th of February.
4th of Feb, so around here. So we actually dropped down, and this was, a knee-jerk reaction because of some of the macro events that Hans was watching at the time. So he was the one that made the call on this one, and I was on holiday in Thailand, so blissfully unaware of what was going on. So as you can see, the stock. I came out. So one of the things we were talking about, we come out quite early of these stocks. Um, and it's because we can then put the capital to work somewhere else. I didn't, and my capital was tied up, and I might have made a few percent up here, but I ended up coming out at about the same level later on. So that's talk of the devil. So this is something that actually it didn't do me any good by staying in, and we tend to find that when we come out of stocks because it's broken one of our rules or another.
I'm going to speed you through one last stock before we end, and that's because we are in the energy sector. And it's B that sent us an email at fomo@mystockscanner.com. Isn't Vestas done dropping? Could you please run a quick 3-point playbook on it? B is asking us. And Liam, it of course is a fave of Danes, the Vestas stock. And it has taken a little bit of a hit lately, but is there any sunshine on the way? Is springtime coming for Vestas?
Do we care about sunshine? We just want wind, don't we, with Vestas? I think for solar, maybe we might be different. Yeah, Vestas, actually, when you look at it, is it a quality company? 59, just about okay. We normally do 55 to 60 might scrape through it if the rest of it looks good, which actually the rest of it does. Yeah, you can see analysts think that it's going to be and increase its profits to a decent amount over the next couple of years. PEG ratio is below 2.5. Fantastic. Analysts are saying, yes, I think it's going to go up. Everything is in the green. So, yeah, what's not to like about it? The current ratio is a debt metric. With a lot of these industrials, they tend to be quite heavy on the liabilities they have. So that you can ignore that particular one if everything else is okay there. From a valuation point of view, it's difficult with Vestas because we had this great big period over here where the stock sort of levitated. That's because they went into negative earnings over here. So people didn't really necessarily know how to value the company. The other trick you can use is to use something like sales, where we can see peaks and trough in the sales process. So we're doing the same thing. We're just using price to sales rather than price to earnings as a number in there. But let's just flip it back quickly just to show you. So analysts effectively think that the stock will go up. They think 11% over the next couple of years. We actually think they could be wrong because if you look here at the worst point, the stock bounced here and went up. So we've just set our red line here, and at the best point recently, we could go higher if we wanted to, but it looks a little bit silly. We're saying, okay, that recent peak is probably where it could go up to in a perfect world, and the blue line I have just set to the bottom of where it bounces down here. So it's quite conservative, but that conservative number gives us a 50% upside that we think is going to happen. And if the worst is going to happen, then 31%. This is the real sweet spot of this valuation technique, because you can see here the analysts are running a bit scared here, saying, actually, we think there's only 11%. We look at it and say, okay, when over the last 5 years, 10 years, 20 years has the stock traded at that sort of level, which is 16? It hasn't. So we're being conservative here, but just less conservative than the analysts. And we think we've found something here that actually they're underplaying it, and there could be a hidden gem. If we decide to carry on this year, we think we could break even. You can see that on the left hand side of the chart. So we come out of it in 10 months rather than just hold for maybe 18 months, something like that. There's a 14% upside and a break even on the downside. So that's still acceptable. And but you can see here, this is where I think it was the US decided they were going to break their contracts with Vestas and come out of and stop using wind power over in some of their big wind fields that Vestas spent a lot of money in. And that instantly dropped the MTIs to red. You can see here, it dropped the stock below the 50-day, and it hasn't really been able to recover from there because there is uncertainty about the earnings. The analysts are less uncertain, to be honest. There are law cases going on at the moment. There's a lot of other projects that investors are involved in. But investors are saying, until we know more, we're going to be in a holding pattern and not really doing things. So I would want to see this stock bounce above its 50, come back down, bounce up again, and that's when we'd probably be takers of the stock, because it's a great stock.
See, that get to be the final words in regards to the stocks that we have been taking a look at here in the show today, the Q&A. But what we do is that we take Q&As every month. That's something that we're going to do. It's a service for you guys. Even if you're not a member, then you can watch this for free and you can get to ask questions and get a little showcasing of our platform. Liam, it's St. Patrick's Day. We already said that in the show. I will let you off the hook because I'm sure that you have a cold Guinness down in the fridge waiting for you with your name on.
I do actually, yeah.
There you go. There you
Yeah.
go. But Liam's going to be back on Thursday, 1 p.m. Central European time, because we also have Thursday Tech. He'll also do the writing at our platform, mystockscanner.com, and you do that every week, and you keep your eye out for tech. We're going to broadcast tomorrow in Danish at noon, as always, and then we have a Danish webinar on Thursday, not tomorrow, but on Thursday at 7 o'clock. Hans-Henrik Nielsen will be in the studio there and take your questions. And it's all about the same three questions. Does it have a quality? Does it have an upside? And is the timing right? That's how we do this. This is the tools we are using. We give you the tools, you use them yourself, and you make the money. We try to make you sleep easy at night. Liam Flavelle, a pleasure as always. We
Thank you.
almost kept it within an hour, and I hope that we'll see all you guys out there again for one of our coming shows. For now, happy investing and take care out there. Happy St. Patrick's Day.
Thank you.